The year 2026 is going to be remembered as the moment the artificial intelligence bubble slammed into a concrete wall. If you look at your portfolio right now, you are probably staring at massive gains in semiconductor stocks and software giants. The market is pricing in a future where AI does everything. But there is a fatal flaw in this narrative. A flaw so large and so physical that Wall Street has completely failed to price it in. Everyone is asking which chip is faster, everyone is asking which large language model is smarter, but almost nobody is asking the only question that actually matters. Where is the electricity coming from? We are sleepwalking into an energy crisis of biblical proportions. The AI revolution is not just code floating in the cloud, it is physical infrastructure. It is rows and rows of H100 GPUs running at maximum capacity, generating heat and consuming electrons at a rate that our civilization has never seen before. Here is the uncomfortable truth that Silicon Valley is terrified to admit. We are running out of power. The United States power grid is ancient. It is fragmented, and it is completely tapped out. If you bought Nvidia because you believe in the exponential growth of intelligence, you need to understand that a GPU without reliable electricity is nothing more than a very expensive paperweight. Today, I am going to walk you through the most critical trade of the next decade. This is not about buying the tech companies that consume power. It is about buying the companies that own the only fuel source capable of keeping the lights on. We're talking about the renaissance of nuclear energy and the inevitable squeeze in uranium. By the end of this broadcast, I will prove to you why the biggest winners of 2026 will not be the companies writing the code, but the companies mining the fuel. To understand the scale of this problem, we have to look at the math. For the last 20 years, electricity demand in the United States was effectively flat. We got better at efficiency, LED light bulbs, energy-efficient appliances, and the offshoring of heavy manufacturing meant that our grid didn't need to grow. We became complacent. We assumed electricity was like air, just always there. Then came the data center boom. A standard Google search uses about 0.3 watt-hours of electricity. A ChatGPT query uses nearly 10 times that amount. And that is just the front end. The training of these models is an energy black hole. By 2026, data centers in the United States are projected to consume as much electricity as the entire country of Japan. We are effectively trying to plug a new G7 nation into our existing power grid every few years. In Northern Virginia, which is the beating heart of the global internet, power utility companies are already turning away new customers. They are telling multi-billion-dollar tech companies, no, we cannot hook you up until 2030. This is the bottleneck. The chip factories can churn out silicon, but the utility companies cannot churn out electrons. So why not just build more solar panels and wind turbines? This is the first question every retail investor asks. The answer lies in the physics of the grid. Data centers require what is called baseload power. They need a flat, consistent, uninterruptible supply of energy 24 hours a day, 7 days a week, 365 days a year. Solar power goes to zero every single night. Wind power goes to zero when the weather is calm. To run $1 trillion AI infrastructure on renewable energy, you would need battery storage technology that simply does not exist at scale yet. It is mathematically impossible to power the AI revolution with intermittent energy. What about natural gas or coal? While they work, the tech giants like Microsoft, Google, and Amazon have handcuffed themselves with aggressive net zero carbon goals. They cannot build massive fossil fuel plants without destroying their ESG ratings and facing a revolt from their own employees and shareholders. This leaves exactly one option on the table. There is only one energy source that is carbon-free, scalable, extremely dense, and runs around the clock regardless of whether the sun is shining or the wind is blowing. Nuclear energy. For decades, nuclear was the hated stepchild of the energy sector. It was associated with fear, regulation, and disasters like Chernobyl and Fukushima. The stock prices of uranium miners and nuclear operators were dead money. But in 2026, the script has flipped completely. Nuclear is no longer a public utility story. It is now a critical technology infrastructure story. The smart money has already figured this out. You just need to look at the deals that were signed in late 2025. Microsoft did the unthinkable. They signed a 20-year power purchase agreement to restart Unit 1 at 3 Mile Island. Think about the symbolism of that. The site of America's worst nuclear accident is being resurrected by America's largest tech company because they're desperate for power. Microsoft is effectively privatizing a nuclear reactor to ensure their AI services don't go dark. Amazon Web Services did something even more aggressive. They purchased a data center campus from Talon Energy for $650 million. They didn't pay that money for the buildings. They paid it for the grid connection. That campus sits directly next to the Susquehanna nuclear power plant. Amazon bought the right to plug directly into the reactor, bypassing the public grid entirely. This is called behind-the-meter power, and it is the new gold rush. Google is investing directly into SMRs, or small modular reactors. These are next-generation mini-reactors that can be mass-produced and dropped on-site. Do you see the pattern? The tech giants have realized that the public utility sector moves too slowly. They cannot wait 7 years for a new transmission line to be approved. So, they are taking matters into their own hands. They are becoming energy companies. They are securing their energy supply chains just like they secured their chip supply chains. This shifts the valuation logic for nuclear stocks entirely. Historically, a nuclear operator traded at a low multiple, like 10 times earnings, because it was a boring, regulated business. But if that nuclear plant is the only thing allowing Microsoft to sell $50 billion worth of AI subscriptions, that plant is not a utility. It is a strategic asset. We are going to see a massive re-rating of the entire sector. A kilowatt hour of nuclear energy is worth infinitely more to an AI company than it is to a residential household. But owning the power plant is only half the trade. The plant is the engine, but you also need to own the fuel. This brings us to the uranium squeeze. The market for uranium is currently in a structural deficit that is likely to last for the rest of this decade. This is basic economics 101. During the bear market from 2011 to 2020, the price of uranium was so low that nobody invested in new mines. It takes 10 to 15 years to bring a new uranium mine online. You have to find the deposit, get the environmental permits, build the infrastructure, and start processing the ore. You cannot just flip a switch. For the last few years, the world has been consuming more uranium than it produces. We bridged that gap by eating into the stockpiles left over from the Cold War and the Fukushima shutdowns. But those stockpiles are now effectively gone. At the same time, demand is going vertical. Not only are existing plants extending their lifespans, but China is building over 20 new reactors. India is building. France is restarting its fleet. And now, American data centers are demanding more nuclear power. We have a situation where demand is inflexible and supply is inelastic. When the utilities realize they're running out of fuel, they don't ask, what is the price? They ask, is there any available? The price of uranium has to go higher to incentivize new production. It is not a matter of if, but when. Furthermore, there is a massive geopolitical premium that the market is ignoring. A huge percentage of the world's enriched uranium comes from Russia and its sphere of influence in Kazakhstan. With global tensions rising, the United States and Europe are desperate to decouple their energy supply chains from Russia. This has led to the banning of Russian uranium imports. This puts a massive premium on uranium, coming from stable, friendly jurisdictions like Canada, Australia, and the United States. If you are a North American miner with a permitted deposit, you are sitting on a winning lottery ticket. The government wants you to succeed. The tech giants need you to succeed. So, what is the impact on your portfolio? If you are overweight tech and underweight energy, you are exposed. The valuations in the tech sector are priced for perfection. They assume that growth will continue uninterrupted. They are not pricing in the risk of power shortages or the rising cost of electricity. On the other hand, the energy sector, specifically the nuclear supply chain, is still priced like a cyclical commodity trade. The market has not yet realized that uranium is the toll fee that must be paid for the AI age to exist. So, how do you execute this trade in 2026? You need to position yourself across the entire value chain. First, look at the physical commodity. Since you cannot store drums of radioactive yellowcake in your garage, the best vehicle is the physical holding trusts. These are funds that take investor capital and buy actual physical uranium off the spot market, sequestering it in a vault. This directly tightens the market supply and tracks the price of the metal perfectly. Second, look at the producers. You want to focus on the largest, most liquid miners in the safest jurisdictions, the blue chips of the uranium world. These companies have the mines that are already operating or are very close to production. When the price of uranium moves from $80 to $150, their operating costs stay the same, which means their free cash flow goes parabolic. These stocks act like a leveraged bet on the underlying commodity. Third, for the risk takers, they are the developers and explorers. These are the junior companies searching for the next big deposit. In a mania, these stocks can return 10 or 20 times your money, but they can also go to zero. Treat this like venture capital. Fourth, do not ignore the power producers themselves. There are publicly traded utility companies in the United States that own massive nuclear fleets. Wall Street still treats them like boring dividend stocks. But as they sign more behind-the-meter deals with Amazon and Google, their margins are going to expand. They are transforming from regulated utilities into unregulated tech partners. The outlook for 2026 is clear. The digital world is hitting physical limits. We have built the brains, but we forgot to buy the food. The laws of thermodynamics are undefeated. You cannot cheat physics. The AI revolution will continue, but the leadership of the stock market is going to rotate. The easy money has been made in the chip designers. The hard money, the real wealth of the next cycle, will be made in the resources that power those chips. Do not be the person chasing the tech rally at the top. Be the person positioning yourself in the one asset class that the tech giants cannot live without. The train is leaving the station. The contracts are being signed. The supply is shrinking. And the price is moving. This is the energy revolution, and nuclear is the only way forward.